Welcome back, and joining me for a look at the day's markets action is Cobus Potgieter from Southern Cross Capital. Thank you so much for your time, Cobus. Let's actually start off with the inflation printer that we did have out of South Africa. They're cooling down in August, now below the midpoint of the SARB's target range. Is it time to pop out some champagne?
Yes, yes. I think there's global consensus, not just local consensus, that this is finally the turning point in both the inflation and the interest rate cycle. And today's print, particularly the core print, which was actually flat month on month, despite a 0.2% expectation, so coming in at zero, which means prices excluding energy essentially not increasing at all over the last month. So that opens up a lot of leeway, takes off the pressure from the SARB, and it allows them to look towards initiating this long-awaited cutting cycle that we've all been hoping for.
Indeed, we will be going into tomorrow with our fingers crossed. Let's get into some of the company news that came out of the JSE. What was the most interesting was Met in terms of the share price movements, because we had a really good rally yesterday after the announcement that they are disposing of their Turkish operations, which have caused them a lot of stress. But now today we are seeing a slump in that share price, investors dumping that stock after they released their interim trading statement, talking about expecting a headline loss per share versus the positive figure that we got in the prior period. Talk to me about what's happening here.
Look, I think there's always a bit of a relief when something like that is announced, as it was before yesterday. And today, well, a bit of realism sets in, but that was brought home by, call it a partial quantification of the underlying damage, which was perhaps worse than the market expected, essentially because of the underperformance of that unit, and it's mainly driven by, the opposite of what we have locally: incredibly irresponsible monetary policy. Of course, the independence of the Turkish central bank eliminated by the Erdogan regime, and they've got some I wouldn't even know what the heck to call their approach to monetary policy right now, which means essentially the country's been in hyperinflation for the last year or so, and that's taken a knife to local industry, and we're seeing this in Meta's expected results. Again, the picture isn't fully quantified, but given that they've essentially wiped out all profits and gone to a slight loss, that's a terrible outlook.
Yeah, so maybe investors forecasting maybe more pain before the sun rises there on that stock. Well, let's talking about the sun. Let's go into Southern Sun. They came out with their interim trading statement today, talking about subdued trading statistics. Was it all base effects from the prior period, or is there more?
Yes. Okay. So the base effect you're alluding to is, of course, the controversial BRICS summit, from which they were a major beneficiary. So that led to, call it a slew of bookings in that complex in Sandton, and ultimately, of course, that doesn't repeat in this period.
Yeah.
On top of that, they had significant renovations at two of their major hotels, one in Sandton and the other one, the Cullinan, here in the Western Cape, and also claiming that despite even stripping all of this out, their uptake sort of result was quite subdued, better than last year. I think about 1% better than last year, but still subdued. Despite this, despite everything we've just mentioned, they're expecting headline earnings to increase by more than 20%. So this is one of those sort of initial trading statements where they signal to the market it's because they've got a capital markets day coming up. So they're not close enough to results to really quantify this, but they're signaling to the market there is that requirement from the JSE. As soon as you become aware, your headline earnings will, or your earnings or your headline earnings will differ by more than 20% versus the prior period, you have to release a trading statement. Technically, it needs to be within the range, but if you haven't quantified that yet, you can release an open-ended one like this. And this, of course, has been pretty positively received by the market. And again, for the hospitality industry more broadly, looks pretty good. So again, good cost control. They're calling it subdued, but clearly things are turning around and looking a heck of a lot rosier than before.
Well, talking about quantification, we did get Raubex saying that they expect their interim headline earnings per share to increase by as much as 55%. Not a lot of color there. Anything to say about that quickly before we get to your stock pick?
No, I mean, it's an interesting one. One of the few companies, who effectively have the government as a major customer that have flourished over the last 2 years. I mean, and particularly alluded to the roads division and the infrastructure division doing well. So, like you mentioned, not a lot of color, but again, an excellent set of results, and that's off a pretty good base already. So, a good execution there.
All right. Well, Cobus, let's get to your stock pick. What are you cemented on today?
So against this backdrop of the interest rate cycle turning, I've decided to go with the property checker. It's quite a well diversified one, Fortress. We of course know they had their woes with the A and the B structure, essentially meaning they lost their REIT status a year and a half ago. However, in the meantime, that structure has been resolved through a partial unbundling of Napier Castle. That still is a significant component, which has done particularly well. The European portion of their holdings. Locally, they hold industrial, office, retail assets, an eclectic, holding, or well, let's call it typical for a local property holding company, but quite a well managed one. And traditionally, when we enter a cutting cycle, that is incredibly good for property. So even though the SA property sector has been the best performing sector over the last year already, given that yields are still high, given that optimism is returning, and given this cut in the start of the cutting cycle, where the finance side, because they're always matching assets versus the cost of finance in these businesses, that comes off over time. They, of course, are particularly exposed relative to their peers to the interest rate cycle. So for them, it's quite positive. So we expect that to be very positive for Fortress going forward. And it's a nice play if you want to benefit from the turn in the interest rate cycle.
All right. Thank you so much for your time and giving us analysis on what came out of the investment space today, Cobus. That was Cobus Potgieter from Southern Cross Capital.